Howdy, folks. Welcome back. It's the weekly wrap-up for Friday, the 19th of November, 2021. I hope everyone's had a great week. It's been pretty nice here. Again, the weather's always really nice here in Colorado, so I know y'all are pretty jealous probably. So anyways, news today, the Rittenhouse trial came to a conclusion. So depending upon, I guess if you're a Democrat, you're probably pissed. If you're a Republican, you're probably happy. Me as a Libertarian, I thought that should have never gone this far. It was self-defense from the very beginning, and there was plenty of video to substantiate that. So, but, from my point of view, I think the right conclusion happened. So, but if you want to give me a call and talk about it, I'd love to go through the case with people. I've watched I didn't watch a lot of the actual case, but pay attention to quite a few lawyers who are, pretty sensible. So, all right, well, let's go ahead and jump into what's going on this week. As far as the indexes, looks like the Dow Jones was down about 1.5%. S&P 500 slightly up about 0.18. NASDAQ was up about 2.13. Dow Utilities slightly up about 0.5%, and the Dow Transports, they were down. So looking at the market as a whole, it looks like, transports and moving stuff around the country was down for the week, and technologies like your NASDAQ was your big winners. So not, the markets, well, let me bring that back up here. If we go out to a daily chart and drag this out for the Dow Jones, let me add my resistance lines back in. So you can see here, we talked about this last week, and if we've had meetings recently, I know I covered this in most meetings. We broke this downward trend. What day was that? The 14th of October, so about a month ago, and since then it's just kind of been meandering. So we'll see if this starts going back in a north east trend, so in a positive direction, or if it's going to head north southeast. So again, we'll see where this goes long term, but let's go ahead and take a look at what's going on with jobless claims. They came in this week at 268,000. Forecast was 260. Last week's numbers were revised up from 267 to 269. So, both these weeks, just slightly above forecast. So certainly not the end of the world. As long as this trend long-term keeps heading in a positive direction. Just 3 months ago, we were in the 300,000s. Now we're in the mid 200,000s. So again, that is positive news. Continuing jobless claims came in at 2,080,000. Forecast was 2.12 million. And again, last week's numbers were revised up from 2.16 to 2.209 million. But again, a slight adjustment that looks like it was about 60,000, 50,000. So certainly not the end of the world. And again, looking at the longer term trend, mid or late July, we were over 3 million, and now we're down to close to 2 million. So I think when those, federal benefits ceased, you see a little more people getting back to work. So as I say, hunger is a hell of a motivator. All right. So these were the economic reports that were coming out this week. U.S. retail sales year over year came in at 16.31. Last month, let's see, the previous was 14.26. So, retail sales seem to be fairly stable right now. Again, we'll see once, a few more months where things stabilize, but that looks pretty decent. Industrial production year over year came in at 5.14%. Again, it did kind of bottom out here in October, and it looks like it's kind of lifting back up here in November. So we'll see, where this goes long term, but certainly some positive numbers there. Housing starts came in at 1.52 million. Forecast was 1.576. Again, we did have, a bit of a lag here last year where, things kind of slowed down. But for the time being, the last 6-7 months, this looks pretty good. So, it looks like the housing market is still fairly strong. Some of that's due to interest rates being as low as they are. That has certainly a major effect. And then, the rig count, I know I talk about this a lot because this affects just about everybody out there, regardless if, you drive a very fuel efficient vehicle or you drive a tank like I do. The price of gas is certainly, can be an irritant. Right now we have 461 rigs online. Last week was 454, so it went up by 7. Again, looking long term, we need to get closer up here to this 600 number. It's a slow creep. I'm not in the oil and gas business. I'm not out there as a roughneck busting my knuckles. So it's, I don't know the actual ins and outs of getting a rig back online. So, it seems to be a slower process than shutting them down. So, all right. So that's all the statistics we're going to look at this week. Did want to finish out the wrap up with an article. Comes from Mises Wire. It's titled, "Since 2008, Monetary Policy Has Cost American Savers About $4 trillion." This is a subject that's near and dear to my heart. I do have a lot of older folks that I work with, and the lack of the ability to save over this last decade and a half has been quite painful. Having to use other securities that don't have the principal protection, like CDs and things like that you only make interest off your money. It's definitely been tough. So let's dive into this. This was published on the 15th, which was Monday, by Alex Pollock. All right, let's dive in. With inflation running at over 6% and interest rates on savings near zero, the Federal Reserve is delivering a negative 6% real inflation-adjusted return on trillions of dollars in savings. This is effectively this big word, expropriating. I'm sorry, I can't read very well. American savers nest eggs at a rate of 6% a year. It's not only a problem in 2021, however, but an ongoing monetary policy problem of long standing. The Fed has been delivering negative real returns on savings for more than a decade. It shouldn't be discussing with the legislature what it thinks about this outcome and its impacts on savers. The effects of the central bank monetary actions pervade society and transfer wealth among various groups of people, a political action. Monetary policies can cause consumer price inflations like we have now, and asset price inflations like we have in equities, bonds, houses, and cryptocurrencies. They can feed bubbles, which turn into busts. They can by negative real yields, push savers into equities, junk bonds, houses, and cryptocurrencies, temporarily inflating prices further while substantially increasing risk. That's something I just talked about. People, whereas they used to keep their money in, a savings account or a CD or even, a short-term bond. Today, to get a yield on that sort of money, you're having to look at dividend stocks and growth stocks that obviously do not have that same protection of principal. All right. Savings are essentially to long-term economic progress and to personal and family financial well-being and responsibility. However, the Federal Reserve's policies and those of the government in general have subsidized and emphasized the expansion of debt and unfortunately appear to have forgotten savings. The original theorists of the savings and loan movement, to their credit, were clear that first you had savings to make possible the loans. Our current unbalanced policy could be described, instead of savings and loans, as loans and loans. Immediate step, Congress should require the Federal Reserve to provide a formal savers impact analysis as a regular part of its Humphrey Hawkins report on monetary policy and targets. This savers impact analysis should quantify, discuss, and project the future the effects of the Fed's policies on savings and savers, so that these effects can be explicitly and fairly considered along with other relevant factors. The critical questions include: what is the impact of Fed monetary policy on savers? Who is affected? How will the Fed's plans for monetary policy affect savings and savers going forward? Consumer price inflation year over year as of October 2021 is running, as we are painfully aware, at 6.2%. For the 10 months of 2021 year to date, the pace is even worse than that, an annualized inflation rate of 7.5%. Facing that inflation, what yields are savers of all kinds, but notably including retired people and savers of modest means, getting on their savings? Basically nothing. According to the Federal Deposit Insurance Corporation's October 18, 2021 National Interest Rate Report, the national average interest rate on savings accounts was a trivial 0.06%. On money market deposit accounts, it was 0.08%. On 3-month certificates of deposit, 0.06%. On 6-month CDs, 0.09%. On 6-month treasury bills, 0.05%. And if you committed your money out 5 years, a majestic CD rate of 0.27%. Wow, that's amazing. I estimate, as shown in the table below, that monetary policy since 2008 has cost American savers about $4 trillion. The table assumes savers can invest in 6-month treasury bills, then subtracts from their average interest rate the matching inflation rate, giving the real interest rate to savers. This is on average quite negative for these years. I calculate the amount of savings effectively expropriated by negative real rates. Then I compare the actual real interest rates to an estimate of the normal real interest rate for each year based upon the 50-year average of real rates from 1958 to 2007. This gives us the gap the Federal Reserve has created between the actual real rates over the years since 2008 and what would have been historically normal rates. This gap is multiplied by the household savings, which shows us by arithmetic the total gap in dollars. So here's a chart here, and I'll have this website, this web link attached. So if you want to go and look at it for yourself, but you can see, starting back in 2008, the loss was $304 billion. 2009, $79 billion, 2010, $240 billion, and so on. And then just this year alone, through Q3, $975 billion. So this was the worst year on record in this analysis. So the interest rates being held at or near zero, while it has been good for those who have had debt, if you've been borrowing through credit cards or loans, you haven't really felt the pinch from having to pay a lot of interest. But it has had its downside, and this is the real effect, is that, for older folks who don't need or who do not want the risk in their portfolios, it has put them in a very risky situation to continue to get the yield that they need. All the while, we've really screwed our older generation. All right, let me finish this out. To repeat the answer, a $4 trillion hit to savers. The Federal Reserve, through a regular savers impact analysis, should be having substantive discussions with Congress about how its monetary policy is affecting savings, what the resulting real returns to savers are, who the resulting winners and losers are, and what alternatives are, and how its plan will impact savers going forward. After 13 years with an average negative real returns to conservative savings, it's time to require the Federal Reserve to address its impacts on savers. So, really good article. I really didn't mean to do that. So, really good article here, and I recommend reading Mises Wire every day. They always have very good articles. You could like it on Facebook and then just see it in your feed like I do. All right, well, so that's everything I had for this Friday. So I've only managed to ramble for 14 minutes. So I'm about 6 minutes under what I normally do. So I want to wish everyone a good weekend. Hope everyone has a fantastic weekend leading into the Thanksgiving week. I will be here. Don't have any plans to to be anywhere other than at my desk. So if you do need anything from me, don't hesitate to reach out and give me a call or shoot me an email. Send some smoke signals. It's always a clear day out here in Colorado, so I should see them from my perch up here on the Front Range. And like I said, have a great weekend. Go out, get some exercise, have some fun, enjoy life. And I'll talk to everyone on Monday. Have a good one. Bye-bye.